In this session on craft beer finance, we want to talk a little bit about financial risk and financial reward, and specifically, hopefully, to dispel some myths that a lot of entrepreneurs, especially craft beer entrepreneurs, have about debt, and that debt is not always bad to use in financing your business. What we want to talk about briefly is an overview of risk and reward and try to separate out what we call financial risk versus operational risk or business risk. In general, when we're talking from a company standpoint, reward is usually the cash flows that can come from an investment. And when we mean cash flows, the net cash flows after paying out expenditures. The other side of it is, of course, the risk in that potential investment. And what we're usually referring to when we're talking about risk from a financial standpoint is the uncertainty in that investment and the cash flows associated with it. For instance, we make $1 million investment in a new machine for our craft brewery. Is it going to provide the cost savings each year like we projected, or will it be a lot higher? Will it be a lot lower? Will there be delays in putting the machine in place? And also, will we have to do a lot of more maintenance than we originally planned? So we add that uncertainty that we didn't plan for. From a financial risk standpoint, what we're primarily talking to is from a company balance sheet and income statement, the relationship of debt versus equity. The best way to illustrate this is financial risk from a very oversimplified example. As you can see, here's 3 different companies, A, B, and C, same level of assets, again, same total amount of liabilities and equity, and the only thing differ between each company is the amount of interest-bearing debt in relation to equity. Company A has no debt whatsoever. B uses $60,000 in debt and only $40,000 for equity for financing the company. And same for Company C. The only thing that differs down below in the income statement is Company B pays interest but no taxes. We're just using this as an example. And Company C pays both interest and taxes. So what's the impact? Well, if we look at Company A, where it made $20,000 in earnings before interest and taxes, same as B and C, if they didn't pay any taxes, the bottom line net income would be $20,000. No interest, no taxes. Now, assuming that we paid a 50% tax rate on our income, Company A would have to pay income taxes of $10,000 or 50% of $20,000 earnings before taxes, and net earnings would be $10,000. If we go to Company B, the reason why we leave out taxes is it allows us to compare A and B only to see the interest expense impact without looking at tax impact. If you add in that $60,000 in debt, and we're assuming they're paying 10% interest on that debt for the year, Company B pays $6,000 in interest expense, which leaves it with lower earnings than Company A. So in this example, there's actually more of a benefit, not at least from this standpoint, to use equity instead of debt. When we add in taxes like we do with Company C, assuming again we pay that 50% income tax, you can see net earnings end up being $7 versus $14 where no taxes are paid by B, or $20 when no taxes are paid by A, or if we had added taxes in A, we would have had a $10. So in this case, even though we use some debt in Company C, we would have been better off by financing totally with equity. But that's not always the same. That's not always the best standpoint. And the reason why we want to point this out is not just we don't want to look at it solely from an income statement standpoint, but also from an ownership standpoint. Remember, the trade-off is if we can use debt, loans, notes payable, and such to finance our company, that means we can keep more of the equity to ourselves. So we have to think in that regard. So a different way to think of things is not necessarily whether you use debt or equity, but whether the return that you earn or the profits you return on that invested capital, does it exceed the cost of that capital, or in this case, the cost of the debt? What we mean is we're going to consider the return on capital. We're going to call it, they use the pre-tax ROIC, return on invested capital. And if that is significantly greater, and significant is kind of a subjective term, but usually 2% or higher, than the cost of debt, then it makes sense to fund with the debt, because we're actually saying, hey, we're borrowing at X%, we're earning a greater return on that debt using Y, so why not borrow more? Now, there's usually going to be a point in time where the more we borrow, of course, in a company, the more risk we'll have because we can't afford to pay it back, or a bank might charge us more interest because they see more financial risk, or we can't find investments in the company to continually earn that higher pre-tax ROIC. Now, when talking about pre-tax ROIC, typically what we're looking at is we're comparing EBIT divided by the invested capital. And remember, invested capital includes both debt and equity. So what's the return we're generating on that, the EBIT divided by that capital? And cost of debt is simply the interest expense divided by the interest-bearing debt. In other words, we borrow money, we pay an interest rate on it. What's the average interest rate we're paying on that? And so the rule is, if for each dollar that we borrow and the cost and the interest we pay on that debt, or the cost of debt for that incremental dollar that we borrowed, if that's less than the pre-tax ROIC, then it still makes sense to borrow money, keep the equity for ourselves, and earn a greater return on invested capital that we can use to pay off the debt, and then the remainder goes to the shareholders. Now, our example craft beer company that we've used throughout, again, remember the EBIT, EBT, and so on for 2014 are shown here. We're going to specifically look at EBIT of 240, invested capital of 1,100, and then we also have debt in this case. So remember, we financed half with debt, half with equity of 550 for the debt. And while it's not listed here, the interest expense, I believe, was $40,000. When we looked at our operating results, when we looked at the ROE components, notice that EBIT divided by invested capital, you can take the EBIT of 240 and divide it by the 1,100 invested capital, and we'll compare that to the interest expense, or divided by the interest-bearing debt. Or pre-tax ROIC is 240 divided by 1,100, which generated a pre-tax return on invested capital of 21.8%. And our interest expense, assuming we keep that interest rate maintains, the average interest expense from our 2014 example was $40,000 divided by our total debt of $550, or the interest rate we paid was 7.3%. So in this example, our pre-tax ROIC is significantly greater than our cost of debt, not even including the impact of income taxes. So in this case, if the company had some potential to say we needed to look at buying new property, new building, whatever, and we could borrow at 7.3% or something around that, and if that investment would generate the average pre-tax ROIC of 1.8% or higher, it's a no-brainer that we should borrow the money and use it to fund for the investment. Now, if the cost of the debt would be much higher, and if the investment we're going to be making would be less than the 21.8%, we'd want to look specifically at that investment and say, is the return going to be greater than the incremental debt? And if so, should we or should we not borrow against it?